Welcome to this CAMS exam preparation lesson on bribery and corruption. This is one of the most heavily tested areas on the exam, and for good reason. Corruption is a predicate offense to money laundering in virtually every jurisdiction. Today we will cover 7 distinct forms of corrupt conduct, the methods criminals use to disguise bribes, the critical line between legitimate hospitality and improper inducements, and the anti-bribery controls you are expected to know. Let's start with foundations. Before you can answer exam questions confidently, you need to distinguish each form of corrupt conduct precisely. The exam loves to test whether you can identify which specific type of corruption a scenario describes. Let's build that clarity now. Bribery is the core concept. It means offering, giving, soliciting, or receiving something of value to improperly influence a decision or action by someone in a position of trust. Two critical points. First, bribery covers both sides of the transaction, the person who pays and the person who receives. Second, it is not limited to cash. Non-cash benefits like luxury travel, favors, or employment for relatives all qualify. Keep this broad definition in mind. The exam tests it. Now let's distinguish the 7 forms you need to know. Bribery is the specific act of giving or receiving value to influence a decision. Corruption is the broader umbrella. Any abuse of entrusted power for private gain. Embezzlement is theft by someone who was trusted with the assets. Think a treasurer diverting funds. Graft specifically involves exploiting political office to redirect public money. And extortion uses threats or coercion. The key difference from bribery is that extortion involves force or intimidation rather than a willing exchange. 2 more forms deserve careful distinction: kickbacks and influence peddling. A kickback is a secret payment flowing back to the decision maker after a contract or purchase is awarded. It is a quid pro quo. You gave me the contract, I give you a percentage. It is often disguised as a consulting fee or commission. Influence peddling is different. Here, a middleman trades on real or perceived access to an official. The middleman sells the introduction or the access, but the official may not even know. On the exam, ask yourself, did value flow back after a decision, or did someone sell access before one? That tells you which term applies. Now let's examine how bribes are actually delivered. Cash in an envelope is the stereotype, but modern bribery is far more sophisticated. Understanding these methods helps you spot the red flags. Bribes take 4 major non-cash forms: gifts and hospitality, luxury travel, expensive event tickets, high-end goods that go well beyond normal business courtesy, donations and sponsorships, charitable contributions made at the official's direction, often to entities they control, employment offers, jobs for relatives who have no qualifications and perform no duties, and inflated invoices, a vendor overbills, and the excess is routed back as a concealed payment. Each of these can appear legitimate on the surface. That is precisely what makes them effective and dangerous. Intermediaries are the connective tissue of modern bribery schemes. Agents, consultants, shell companies, and even charitable foundations create layers of distance between the bribe payer and the corrupt official. A common pattern: a company hires a local agent who invoices for advisory services. The agent passes a portion to the official. The company's books show a legitimate consulting expense. The official's receipt is invisible. This is why third-party due diligence is so critical and why the exam tests it repeatedly. Now we reach one of the most important distinctions for the CAMS exam: the line between acceptable business hospitality and an improper inducement. This comes up in multiple question formats, so let's get it right. Legitimate hospitality is modest and proportionate to the business relationship. It is transparent, recorded, disclosed, and often pre-approved. It is not timed around a pending decision, bid, or contract. And it is offered openly to the organization, not secretly to an individual. An improper inducement is the opposite on every dimension. It is lavish or disproportionate. It is secret or off books. It coincides with a decision point, and it targets the individual personally, bypassing their employer. When you see a hospitality scenario on the exam, run through these 4 contrasts systematically. Here are the 4 tests distilled into a simple checklist. Proportionality. Is the hospitality reasonable for the business context and local norms? Transparency. Is it disclosed and, where required, pre-approved? Timing. Is it disconnected from any pending decision or contract? And reciprocity. Would you be comfortable if this appeared in a regulatory review? If any single test fails, treat the hospitality as a potential bribe. The exam often presents scenarios where 3 tests pass but 1 fails. That one failure is enough. Let's connect corruption to money laundering. This link is fundamental. Corruption generates illicit proceeds that must be laundered before they can be enjoyed openly. That is why bribery is a predicate offense and why financial institutions are on the front line. The cycle follows the classic 3 stages. In the receive stage, the corrupt official obtains the bribe, often through an intermediary or shell company. In the layering stage, funds move through multiple accounts, jurisdictions, or corporate structures to obscure their origin. In the integration stage, the official enjoys the proceeds as apparently legitimate wealth, real estate, investments, luxury assets. Your role as a compliance professional is to detect these flows at every stage. What red flags should trigger concern? A politically exposed person or PEP whose wealth is clearly inconsistent with their official salary. Payments flowing to or from jurisdictions with no apparent business connection. Complex corporate structures that serve no commercial logic, and sudden large transactions that coincide with a contract award or government decision. Remember, corruption proceeds often enter the financial system already disguised as consulting or advisory fees. They look clean on the surface. That is why enhanced due diligence on PEPs and their associates is so important. Now let's examine the control framework. Anti-bribery compliance is not a one-time exercise. It is a continuous cycle of assessment, prevention, detection, and response. The anti-bribery control cycle has 6 stages that repeat continuously. Risk assessment identifies where your exposure lies, which products, jurisdictions, and customer types carry the highest corruption risk. Due diligence screens third parties, intermediaries, and PEPs before and during the relationship. Monitoring uses transaction surveillance to detect patterns consistent with bribery. Escalation ensures suspicious activity reaches the Money Laundering Reporting Officer, or MLRO. Remediation addresses control gaps identified through investigations, and training ensures all staff understand their obligations. This cycle never stops. It adapts as risks evolve. Due diligence deserves special attention. You must screen all agents, consultants, and intermediaries, not just direct customers. Verify beneficial ownership of every counterparty. Assess PEP status and demand evidence of source of wealth. And review corruption perception indices for relevant jurisdictions. Enhanced due diligence, or EDD, is mandatory whenever a relationship involves a politically exposed person. This is not optional. Regulators expect documented evidence that you assessed and mitigated the corruption risk. When should you escalate and file a report? When payments have no commercial rationale. When a customer refuses to explain the source of funds. When transaction patterns match known bribery typologies. When intermediary fees grossly exceed market rates, and when PEP activity is inconsistent with declared income. Any one of these indicators may justify a suspicious transaction report. Multiple indicators together make reporting essential. Let's test your understanding with 3 CAMS exam-style questions. These mirror the format and difficulty you will encounter on the actual exam. Question 1. A government official's nephew receives a consulting contract from a company that just won a public tender. The nephew performs no work. Which form of corruption does this best illustrate? Is it A. Extortion, because the company was coerced into hiring the nephew? B. A kickback, a secret return of value to the decision-maker's circle? Or C. Influence peddling, where the nephew sold access to the official? Pause and consider which specific form this scenario matches. The correct answer is B. Kickback. A no-work contract awarded after the tender is a classic kickback. Value flows back to the official's family circle as a reward for the contract decision. Extortion requires threats or coercion, which are absent here. And influence peddling involves selling access before a decision, not rewarding someone after one has been made. The timing and direction of value flow are your keys to distinguishing these terms. Question 2. Which factor most clearly distinguishes legitimate business hospitality from an improper inducement? A. The hospitality is offered by a large multinational corporation. B. The hospitality is proportionate, transparent, and not timed around a pending decision. C. The hospitality is provided in a country where gift giving is culturally expected. Or D. The hospitality costs less than $1,000. Think about which answer captures the essential tests. The correct answer is B. Proportionality, transparency, and timing are the three decisive tests. The size of the company offering the gift is irrelevant. Cultural norms do not override anti-bribery law, and there is no universal dollar threshold that makes hospitality automatically acceptable. A modest gift timed to influence a pending decision can still constitute an improper inducement. Always apply the three-part test. Question 3. A bank client, classified as a PEP, receives large wire transfers from a shell company in a high-risk jurisdiction shortly after a major government contract is awarded. What is the most appropriate first action? A. Close the account immediately to limit the bank's exposure. B. File a suspicious transaction report and conduct enhanced due diligence. C. Contact the client to request an explanation before taking any action. Or D. Ignore the activity because PEPs are expected to have large transactions. Consider the regulatory obligations that apply here. The correct answer is B. File a suspicious transaction report and conduct enhanced due diligence. The combination of PEP status, shell company origin, high-risk jurisdiction, and timing around a contract award creates strong corruption indicators. Filing an STR and applying EDD is the proportionate regulatory response. Closing the account without reporting may constitute a failure to report, or even tipping off if done to avoid scrutiny. And contacting the client first risks alerting them to the investigation. Never ignore PEP activity simply because large transactions are common for officials. Let's recap the key points from this lesson. 7 forms of corrupt conduct: bribery, corruption, embezzlement, graft, extortion, kickbacks, and influence peddling. Each has a distinct definition, and the exam expects you to apply the right label to specific scenarios. Bribes take cash and non-cash forms: gifts, hospitality, donations, employment offers, intermediary fees, and inflated invoices. The hospitality test has 3 pillars: proportionate, transparent, and not timed to a decision. If anyone fails, treat it as a potential bribe. Corruption proceeds must be laundered. PEPs and their associates are inherently high risk, requiring enhanced due diligence. And your control framework must include risk assessment, third-party screening, ongoing monitoring, and clear escalation to file suspicious transaction reports. On the exam, always identify the specific form of corruption first, then apply the proportionality, transparency, and timing tests for any hospitality scenario. That discipline will carry you through the toughest questions.